What is up, guys? My name is Nash and welcome back to another video. And today I'm going to be talking about I know the title is a little dramatic, but I feel like this is a topic that's never really covered, by a lot of people that make these types of videos. All right, so dividend investing, that's the safest form of investing that you can do because you're holding these stocks for long term, so that minimizes risk of compared to day trading. But at the same time, there are downsides to this. It's not always like, you're going to get paid a lot of money. So I feel like a lot of people that get into dividend investing, they expect to make a lot of money from dividends, but they don't realize that you have to put in a lot of money to receive, a lot of money back in dividends. And there are downsides to dividend investing, which is what I'm going to be covering in this video. So the first one is going to be you're not entitled to receive a dividend, right? So dividends can be taken away anytime. I guess you can think of them as, it's a privilege, not a right, so they can be taken away. If a company isn't making enough money to pay investors, it can be taken away. A good example is going to be Ford. I was a huge fan of Ford because they had a high dividend yield, and, they were doing well. But when the pandemic started, they cut their dividend because they weren't able to make the money to support themselves and to also pay investors. So they just cut the dividend yield. All right. So how do you avoid, those types of situations? So it's impossible to avoid, to find the perfect company that's never going to cut their dividend. It's impossible, but you can do some research to minimize that risk. So the first thing you're going to look at is the dividend yield. Of course, that's what a lot of people look at, because if it's high, that means they're going to get paid more. Sometimes it's hard to sustain a high dividend yield, right? Because you might be increasing it every year. Let's say you have an 8% dividend yield, which is really high. And, that's not sustainable, because if your profits go down, you have to pay that 8%. The other option is to cut the dividend or just reduce it. So it doesn't have a lot of potential to go up, compared to a company that has, let's say it's paying, a 2% dividend yield. And that's really on the low side of, of dividend yields. If this company makes a little extra revenue like this year, they can increase their dividend, safely, because they have room to grow. They have room to grow than a company that's kind of like maxed out on the dividend yield, because you can only go so high with dividend yields. And another thing to look at would be payout ratio. So what is payout ratio? So this is basically a percentage of how much the company is paying investors from the money that they get or revenue. So an example would be a company that pays 40% of their revenue to investors. So if they're paying 40% in dividends, which is paying investors, the other 60% is going to be reinvested into the business. One of the things that makes businesses grow is how much money is being reinvested into the business, which would probably be buying more machines or hiring more people, stuff like that. So that's what reinvesting into the business means, because you get more resources. But now imagine if a company is paying 80% in dividends, which is the payout ratio, but then the other 20% get reinvested into the company. So if something bad happens, they only have 20% to reinvest. And if that 20% isn't enough, they're going to go ahead and cut the dividend, right? So when you're looking for dividend companies, when it comes to payout ratio, you kind of like want to aim for a payout ratio that's not over 90%, or sometimes you might want to avoid 80%. And you also want to invest in companies that are actually making money. And you can find this on an income statement. It tells you if the company is making, a profit, or if they're making a loss. And the next point is going to be dividend stocks are mostly value stocks. So there are value stocks and growth stocks. And, there's also hybrids, so you can't say this stock is definitely a value, this is a growth. There's some that are both, so they're kind of like a hybrid, but most dividend stocks are value stocks. Think about Coca-Cola. They own so many brands that, it's a value company. So you're not going to see Coca-Cola jump 30% in a day because it's not a growth stock, because the company has already passed the growth phase. Now it just holds the value that it has. So if you look at a company like Amazon or maybe Facebook, they don't pay any dividends at all. So they reinvest 100% of their money into the business. They have a high growth than Coca-Cola, which pays dividends. So they can only invest a certain portion of their money back into the business. So that's kind of like what you got to look at. So don't expect a dividend stock to, jump 20% in a day or 10%. But those are the two things that I want to cover. I know there's way more things, that you have to look at, but those are kind of like, what I think is important to me, because, everyone is different. They look at things differently. So I wanted to cover those two. But if you want to add to this, leave a comment below. And also, if you want to get a free stock, make sure to go ahead and use my Robinhood link in the description below. You're going to get a free stock, and I'm going to get a free stock. But thank you so much for watching, guys. Make sure to go ahaven't hit the subscribe button below if you haven't already. And I'll see you on the next one. Peace.